Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Joe, remind me, where are you? Where are you? Are you in Chicago?
In Chicago, right. Downtown Chicago, yep.
Awesome. Yeah, I lived there for 8 years. Loved it. Fun town. Have you been there your whole life? Did you grow up there?
Well, not whole life. No, I was on the West Coast. I was out in Portland, Oregon for about 5 years in the early mid-90s, but in Chicago for, 25. I live on the north side up in Roscoe Village, so just about a mile due west of Wrigley Field. And yeah, it's been great. It's one of those cities that's, got a bad rap nationally, as you know, but it's also probably one of the most livable, best big cities in the country at the same time. It's weird.
I love the neighborhoods. Yeah, the neighborhoods are great. And I think where you are is fantastic. So I guess I have to assume you're a Cubs fan as opposed to White Sox.
Wrong.
No?
Wrong. Wrong. I mean, both of my kids, I've brainwashed both of my kids to be White Sox fans as well, which is just a horrible parenting thing to do. Their school is literally 3 blocks from Wrigley Field. And
wow.
Yeah. I was treating them to boo out the window when I was driving them to school.
Well, you're training them to be tough kids because I'm sure they get it in that neighborhood a little bit.
Indeed, no doubt.
Awesome. Well, listen, thanks for joining me, and to the audience, thanks for tuning in to another Trends with Benefits. I'm speaking with Joe Taiber, founder and CEO of Taiko. And among other things, I think we'll be talking about alternatives, growth of that space and demand in that space, economics. And I can tell you from our prep session, it could be wide ranging. So I'm really kind of curious to see where we go here, Joe. Typically, I like to do an overview of somebody's company kind of towards the end and all that. But I think it's interesting. And I'd love for you to kind of give a little spiel about Taiko. First off, I'm curious about the name. I didn't know if it was a name that two partners put together, or is it does it mean something?
It is. It's actually both. It's my name being Joe Taiber, and my partner Phil Kosmala, Taiko. So the former, yes, 2 partner names put together. Does it mean something? Interestingly, yes, it does at the same time, but it was totally unintentional. Taiko is I don't know, they're like the big Japanese drummers. Those are called taiko drums or taiko drummers, something to that effect. So, I mean, was that intentional? Definitely not. It was an unintentional consequence or unintended consequence. But Taiko is definitely Joe Taiber, Phil Kosmala. We've been working together. Our story goes way back to the mid-late 90s, actually, where Phil came out of the SEC, and I was with another investment consulting group. And long story short, we've been working together every day since then across 2 separate companies until we founded Taiber Kosmala over 10 years ago and launched Taiko, our dedicated RIA OCIO practice about 4 years ago as well. So yeah, we're technically 2 companies, but all staff, resources, those sorts of things reside under the Taiber Kosmala brand, and the Taiko platform serves that independent RIA channel.
Fantastic. And what are you, on a daily basis, what are you really focused on right now in terms of the growth of the company and services that you offer? Is there a particular area that is of interest to you?
Yeah, I mean, it's pretty broad. I mean, when we work with clients at Taiko, our clients are independent investment advisors all around the country. We advise on collectively over $13 billion in assets across that channel, as well as our institutional channel. Institutional channel would be pension funds, endowments, and foundations. The common denominator, though, Ed, is that our primary charge is to assist clients or collaborate with clients in developing customized investment programs, investment solutions, and the Taiko value proposition takes things into technology and operational outsourcing services as well. So we're really focused, the core focus of our business, without question, though, is investments, markets, economics, and how to navigate investment programs for our independent RIA channel, as well as our institutional clients.
And so that you would help them research and get access to different types of investments in different asset classes?
Exactly. Yeah. Traditional asset classes. Again, we've been in the saddle, if you will, for, better part of almost 2.5 decades doing this for some pretty sophisticated clients. Looking all the way back across our careers, we've just been in a fortunate situation to work with some really smart clients, well-informed clients, and design some pretty sophisticated investment programs, the likes of, Baylor University, Oklahoma State University, the state of Pennsylvania, several name brand corporate pension funds. So helping those boards or those trustees or those investment committees design pretty sophisticated investment programs, and then taking that and applying that to the independent RIA channel has been a real challenge. But also a benefit, because we see that market as, somewhat underserved with regard to the resources for navigating programs intelligently, and something that we see as a great opportunity. So, yeah.
If you had to identify one of the biggest trends that you've seen over the last few years, would it be in alternatives, interest in alternatives, or are there other pockets of the asset allocation portfolio that you see as a common denominator across clients?
Yeah, I think I would. If I had to say one, biggest, attention grabbing opportunity, I think it's probably alternative investments. That said, I think we've always approached, we've been working in designing dedicated alternative investment programs for the better part of, 20 years. We had standalone alternative investment in programs that we've designed and run on behalf of institutional clients, where we have a pretty deep bench of hedge fund investments, a pretty deep bench of real asset investments that would cover real estate or infrastructure or timber or agriculture, things along those lines. And then lastly, private market assets, which would be private equity or private credit. And I guess trends in the last 10 years, I think alternative investments is I think it's one of those labels that I always kind of cringe, because it's such a broad brushstroke label. And what does it really mean? So it's really difficult. And it's also something that we've always approached with a kind of a guilty until proven innocent perspective, because a couple of things you can pretty much guarantee are, they're going to come along with higher fees, which adds to the guilty side of the ledger. They also oftentimes will come along with a little less transparency, and oftentimes a lot less transparency than something in the public markets. So when you can't see stuff really well and it's priced really expensively, I think the guilty until proven innocent approach makes a lot of sense. But it also I think makes a very strong case for what we do for and with clients, which is taking our 20 plus years of experience in that space and enabling the independent RAs that we work with, or the institutional clients that we work with, to harness that expertise and that time in the saddle to make, educated, informed, and well-documented, decisions on that front. So,
yeah, it's funny. Like, I have a hard time approaching that space or understanding that space, or sometimes I get pitched things from entities I've never heard of before. And I'm like, all right, how do I approach this? And, to your point, you're saying it a lot of times comes with higher expenses, less transparency. I don't know, generally, if you can make a broad statement about returns, I assume that they're not all great returns, and maybe that's to your point, that you have to have that due diligence, and I expect that's where your experience comes in.
Yeah, I mean, the outcomes, i.e. the performance outcomes, there's so many different things that impact that. How crowded. I think if I had to, if I have one kind of true north rule of thumb, in the alternative landscape, and it definitely applies to the private capital markets, private equity and private credit, as well as the real asset markets. It's, a good rule of thumb is, if you can be a provider of capital in a capital-starved environment, your outcome is generally going to be pretty good. And that's when other people are hesitant or fearful to be allocating capital, that's when that theme or that trade or that strategy, that space is less crowded. And less crowded translates directly to better outcomes and better performance. So that's kind of I think a good rule of thumb. I think when you look at the alternative investment landscape and drill down into the different types of private market strategies like, private equity or venture capital or private credit, those sorts of things. The one area that, back to trends, this being the Trends with Benefits podcast, back to trends, I think private credit is the one asset class that probably, in the institutional space, it goes back, 20 years, 15 years, 20 years solidly. But it's definitely, I think, officially on the menu now. When institutional clients are constructing well-run programs for an endowment client, a pension client, on the menu now is private credit. And that was not a menu item when we started in the industry, back in the 90s. It really wasn't, but it's been widely accepted for a lot of really good reasons, we think. But that's probably one of those trends I would point to, for sure.
Yeah, I think we've noticed that too. I've heard that, especially over the last couple of years, that private credit has been a major source of interest or a major area of interest. And I'd love to go into some of the reasons for that. But, during our discussion prior, I shared with you some stats that one of my colleagues shared with me, which was showing that funding to a lot of alternatives, including private debt, is down 19% year over year through June of 23. Do you see that as a blip or as maybe a turning trend? Because I've also heard from like these colleagues as well that institutions are now asking, how do I get out of this? And they're starting to ask tougher questions, kind of perhaps because of the interest rate environment or where we are currently in the economic cycle.
Yeah, I think those 2 points you just made, those last 2 points, the interest rate environment as well as the economic cycle, are pointing directly to that. The reason that not just private credit, but really private market strategies across the board in 2023 have had some headwinds in terms of fundraising. So that should, back to my earlier comment, that translates directly to maybe, hey, this is not a bad thing. This is a less crowded space. A less crowded space, when there's less people coming into the ballroom, you have more room to dance. And that's one of those things that I think interest rate environment, to start with that, no question, that impacts the financing of private market assets. When a private equity firm, for instance, is looking at a particular target and the cost of capital required to finance the buyout of said target company all of a sudden went up by 50 or 60% relative to what it was, 9 months ago, that's going to impact, the returns, the return outcome for sure. No question. Therefore, the end appetite of the limited partners allocating to those private equity, strategies. So I think the interest rate environment definitely is a headwind. It's also a very attractive thing in other parts of the private market, though. Things like private credit. When you have a higher interest rate shelf and you are a lender of capital, you're garnering now what used to be 6, 7%, maybe 8% unlevered returns. Now in the private credit markets, you're looking at 9, 10, 11% in a lot of cases unlevered returns. And that's, again, there's rising interest rates both hurt and help. I think from a fundraising perspective, it probably net hurts. The other thing that net hurts would be the second thing you said, which is the economic cycle. Fundraising across private market strategies is done in the context of an overall program of investing. And if you think about that, 2022 was a rough year in the equity markets. It was the worst year in the fixed income markets since the 18th century. So when you really think about what happened to the liquid side of these programs across the board, because they've come down dramatically, the relative sizing of stale-priced private market assets increased. So there is definitely an increase in what we call secondary market activity, where investors in private equity or private credit are looking to solicit bids to sell off interests in the partnerships that they are invested in to rebalance their portfolios. So both headwinds from a fundraising perspective and an increase in secondary market sales solicitations are kind of the takeaway from the backdrop of the financial markets as well.
And of some of the other areas in the alternative space, say hedge funds, real assets, am I right? Hedge funds have kind of had a tough go over the last few years. And Is that going to change, or has that changed given interest rate levels and perhaps volatility in the market, maybe more opportunity for them?
Yeah, I think so. I mean, hedge funds, they often get a bad rap, I think, and a lot of times a well-deserved bad rap, honestly, given the fact that they generally charge higher fees than obviously a lot of traditional and certainly passive products. I think the biggest misunderstanding about the hedge fund space, there's two things I'd say. One, when you say hedge fund, there's so many different types of strategies that are executed within these hedge funds. Some are very credit-centric and credit-oriented. Some are seeking to exploit arbitrage and mispricing opportunities within a capital structure of a particular company or two companies. And some just go long, short stocks. And, and some have more macro-oriented strategies, like trying to put a trade that's going to profit on the German Bund versus a Japanese JGB, a Japanese government bond yield. So looking at global macro interest rate things and interest rate parity, currencies, commodities, more of a global macro type approach. So the thing about hedge funds is you can't say hedge funds are this, because they strive to do very, very different things. The other thing that I think is important for listeners to understand is that hedge funds, generally speaking, they really do operate in a lower risk capacity than just buying the S&P 500. So what do I mean by that? I mean, when you look at volatility statistics generated from most hedge funds, even just equity-oriented hedge funds, there's what was it called? It's called the Jones rule, I believe, going all the way back, the inception of hedge funds back in like the 1950s and 1960s. The generally accepted model hasn't changed too much, just speaking to just long, short equity type hedge funds, where net exposure to the market generally is about 60%. So for every dollar that you invest, they're going short some stocks and going long other stocks. But when you mesh those together, and what I mean by short and long, of course, is short is betting on something going down, long is betting on something going up. So different directional trades. The net of that brings you to about a 60% net exposure to the overall market. And what does that mean? That means that if the S&P 500 is up 10%, you should only expect to be up about 6%. If the S&P is down 10%, you should also expect only to be down about 6%. So 60% of the move is what that really means, or the risk. The headlines love to say, oh, hedge funds again underperformed the S&P 500. Every time I read that, I'm like, well, of course they did. They always underperform the S&P 500, almost, unless it's a down market, right? So you look at a year like what we've had so far, double-digit year this year of the equity market so far. We'll see. I just never expect hedge funds. That's not the point of why we put them in portfolios. We put them in portfolios to manage risk, not to just beat the S&P 500. So I think that's one thing that's clear to understand, or need to understand.
Thus the name hedge funds, I guess.
Great.
If there were areas that you're looking at in terms of the alternatives market, not to ask you for a recommendation, but what do you find interesting, whether it's across real assets or private credit or different styles of hedge funds?
Yeah, I think I'll point out a few things, actually. One would be one that we already talked about. That is private credit. We really think private credit is a great place, again, to be a provider of capital in the absence of capital providers. So I think private credit, which we don't need to elaborate on anymore, is something I would mention right off the gate. The other one is that really is more in the hedge fund space, but it's also in the private market space, are strategies that are designed to take advantage of what we call a credit cycle. And a credit cycle is just generally if you do see declining economic growth or potentially recessionary type environment over the coming, say, 12 to 24 months, which is, I think, the market's consensus view, by the way, right now. A lot of times you have whether hedge funds or private market strategies that are designed to take advantage of that. And those are called stressed and distressed oriented strategies. There's hedge funds that specialized in finding beat up credits on sale, the blue light specials in the public markets, finding companies that have really stubbed their toe or have been impacted by the economic trajectory in the private markets, and coming in through the debt security, knowing that they're going to flush the equity holders of that company. Those are opportunities that can generally do really well if you do have a downturn in overall economic activity. So I think private credit for sure, stressed and distressed credits also. And then you have to take a real close look at what's a really difficult asset class, but real estate. Again, we always like to sort of swim toward the fire or walk into the fire a little bit. That's the right rule of thumb in investing. Be fearful when others are greedy, be greedy when others are fearful. And real estate is pretty scary right now. I'm sitting here in the Chicago Board of Trade looking out my window right now at a lot of buildings that are probably about 60% full, right? So the fundamental and structural changes that the pandemic has inflicted, obviously on the office sector, but there's ripple effects to that. There's big ripple effects across commercial real estate, some positive, some negative. So real estate is something that looking at interesting opportunities from here forward, I have to put real estate and choosing a manager, an underwriter of opportunities in the real estate space to take advantage of those positive ripples and value buy properly in those negative ripples is paramount. So I think real estate would be the third one I shine a light on.
Maybe to kind of wrap up our discussion on alternatives briefly, if you could hum a few bars on how to approach putting it in a portfolio or an asset allocation. Are alternatives a sleeve, or does each different type of alternative get its own kind of allocation based on what? On historical correlations to the rest of the portfolio? How do you approach the asset allocation decision?
Well, I would cast a little caution on optimizing a portfolio, and financial advisors on this call would know what I mean by that. I would hesitate a little bit on that because the data sets across alternative investments being not liquid, being not priced daily, optimizing alternative investments with daily liquid stocks and bonds really doesn't work. It doesn't work. So I'd hesitate a little bit on that front. How to size things and how to frame things with investors, I think that comes down to a few things. One is liquidity. The first question we always like to challenge clients, whether it's an investment committee or a pension fund or whatever it is, what are your liquidity needs? So you can really back into that liquidity threshold. We will oftentimes in a policy, an investment policy statement, really define a maximum amount of illiquidity that's allowable or sustainable by that fund or by that client. And then secondly, we'll go a next step and say, what about semi-liquidity, meaning something that might have liquidity windows, like a hedge fund maybe, or an interval fund or something along those lines. So I think zeroing in on liquidity first and foremost, I think is the right place to start, because a lot of times you can't back that train up. Once you put money to work in the alternative landscape, depending on the complexion of it, it's not really simple, certainly in an illiquid position, to back out of it. So that's where you can end up and needing to turn to the secondary market, like institutional investors certainly do, to sell an interest in an illiquid investment. You're going to have quite a haircut. Expect a haircut if you're going to the market asking for liquidity where they know you need liquidity and you're willing to pay a price for it. And that price is a discount to what you actually think it's worth. The other one is really risk appetite. You do need to look at a correlation of certain strategies relative to how they correlate to other stuff that you have in the portfolio. What you don't want is everything, for instance, everything being one-way directional. If everything is floating the same direction, it's going to float the same direction up, but sadly, it'll float the same direction down as well. Looking at correlation and diversification, those sorts of concepts also. We do generally approach construct of alternative investments within a portfolio in those buckets. We identify real assets and specifically what real assets might make sense to this client. Then we turn the page and do education on hedge funds. What hedge funds might make sense to this client? And then we turn the page again to do the same thing in private markets, and what are private markets and what makes sense to this client. And most clients, interestingly, on the latter, the private market side, most clients definitely, we've found, will opt or be more open to private credit than they would be to private equity, even though it's kind of a newer asset class. The real reason for that is that the risk attributes of private credit, they kind of make sense to people. You're instead of, buying an equity interest in a private company, you're making a loan to that private. You're a bank. You're acting as if you're a bank in effect, and with that loan, you're actually sitting on the top of the capital structure as opposed to the bottom of the capital structure. So again, people kind of, particularly risk avert people, they'll oscillate in the direction of private credit because you have a better outcome in a negative scenario, just given where you stand on the capital structure. And you've got some protections built in contractually in a loan document as well. So once people get their hands around the risk side of that private credit equation in that latter bucket, we generally find that people have appetite.
And who doesn't like regular income payments?
Right, exactly. Yeah.
So we have a few minutes, and I want to touch on something that you mentioned during the prep call a little bit. But as I think about everything that we've talked about so far, it seems like you really have to have an outlook on the economy broadly too, which way it's going to go. And it seems to me that interest rates or interest rate levels or expectations for interest rate changes are potentially hugely important. Am I right about that?
You're 100% right. I think we could unpack interest rates for a while. We've had a sharp we had a super sharp move up in interest rates in 2022. Really, this year and here into early October, we're seeing another one. I don't know. I think the 10-year yield is now up north of 4.75%, which is a huge up move. And I don't know, and going back and forth, we just had an investment committee meeting this morning, actually, and really trying to unpack what the impacts of those higher interest rates are relative to the overall economy, relative to consumers. And I think I keep landing on this idea that both consumers and companies are just going to have to figure out how to survive and operate in what's actually a normal interest rate environment.
Right. We've been here before, right?
Hey, if you look at the long-term average on the 10-year U.S. Treasury, guess what it is? It's 4.5%. It's right about where we are now. We are so, biased to the near-term future, the near-term history that we've just been through, and that's the last 10 years, where we're anchored, a behavioral finance 101, we're anchored to most recent past is extrapolated into the future. And that's just not the case. I question, our investment committee really questions whether we're in a 2% inflation world. The obvious changes that both the pandemic, that demographic changes, structural changes in the real estate world, the economy, I have a real hard time, getting back to why are we all anchored in 2010 to 2019 or 20 as normal? Well, first of all, the interest rate world then was not normal. It was abnormal. And furthermore, the structural impact here of the pandemic to the overall economy and what implications that has for inflation, I'm really questioning. We may be in a 3% inflation world. When you and I started in this business, that was kind of the normal world. When you were running a financial plan, you were plugging in 3.5% inflation.
Exactly. I remember that. Yeah.
Yeah. So, those days, maybe that's back to where we are. And is that a bad thing? It's not the end of the world. It's really not. But I think we need to adjust. Both consumers and companies just need to figure it out and to figure out how to really price and how to price their business and where risk-free rates are sort of back to where they, have been long term.
Do you think the Fed will continue on their push to hit that 2% inflation level, or will they back off and accept that 3%?
Well, I don't know. I think right now they're going to continue their push. You can only take them for their word, which is every 3 months. So, I think they're pretty much on record that the most recent Fed meeting in particular, they're going to stay higher for longer. They told the market to back off on expecting some kind of dovish pivot. I think they're going to be the tough parent. The scary thing about that is, historically the Fed hikes until something breaks. And we all kind of thought maybe it was the banking sector back in March of this year. It turned out that we had a quick response by policymakers and regulators to avert that. But usually, this higher interest rate shelf, pressed by the Fed is probably going to break the back of something at some point. And I just don't know exactly what it is. But we are getting much more cautious when we look out over that 12 to 24 month for that reason, that interest rate reason.
When you get more cautious, that puts you in where? Does that put you in cash, or does that put you in hedge funds, for instance, in a certain strategy?
It does. Well, hedge funds, maybe not so much. I mean, yes, some hedge funds, definitely. I would look at some hedge funds, like more global macro-oriented hedge funds, as pretty attractive in an environment where the directional nature of public markets might not be friendly. Global macro and CTA strategies can do pretty well, regardless of the direction. They just need a trend, not so much a particular direction. So yeah, some hedge funds we think might be poised pretty well. Private market strategies, like I said earlier, private credit, we think ought to do pretty well because you're just sitting in a good vantage point to be, again, that provider of capital. But also just with markets, getting more defensive would be, moving away from things that are higher beta, beta things like maybe international equities or small cap equities, even though they're flat out on sale right now. If we tip into recession, I'd expect them to underperform more blue chip, global type companies. So there's a lot of things that are feeding into sort of a risk view. We're still pretty neutral, and we have maintained a pretty neutral position with regard to overall market risk or risk assets and beta and the like. But we're definitely looking, when you look out over 12 to 24, we've got kind of more of a -1 stamp on a -2 scale. So yeah.
Man, I feel like there's so much I could continue to talk to you about. I kind of wish I was a fly on the wall of your investment committee. But I've enjoyed everything we've talked about so far. And I just want to take the opportunity because I'll ask this question. What is one long-term trend you see playing out over the next year or several years? And it can be about what we've talked about, or it can be about totally something else that you find interesting. I'm just kind of curious.
Well, I mean, you talked your book, I'll talk mine. Ed. I mean, that's 100%. A trend that we've seen is the sophistication and the complexity of the financial markets and how to navigate them. And that can come to stocks versus bonds versus alternatives. It can come to private market funds versus BDC funds versus what's a 506C versus a 506B, like all the different technicalities in navigating those decisions. The partnerships that we've really seen and the trend that we've seen in terms of advisors leaving wirehouses for a lot of reasons, and going independent and seeking partnership of an institutional partner that acts as a collaborator on making decisions and a provider of resources, helping their clients. That's a trend that's been happening for 10 years, and we've only seen it accelerate, and being out there in the marketplace, looking at those partnerships with those independent groups, and basically leveraging our institutional infrastructure on behalf of their end clients is something that's a business line and a trend, both, that we're super excited about, because I think it is a win-win situation for their business. It is a win-win situation for the end clients. And ultimately, the overall market and the evolution of the marketplace, providing more opportunities for clients, although it makes it more complex, it also makes outcomes better, in terms of achieving your investment goals too. So it's something I think I'm really excited about.
Fantastic. And now I want to take the chance to ask you about a few different things, kind of quick hits. This is called trend or fad. Ready?
Fire away.
All right. Hybrid work situations, trend or fad?
Trend.
Buying T-bills, trend or fad?
Fad.
Crypto, trend or fad?
Fad.
So you don't model that into your clients' portfolios currently?
There's not enough risk. There's not enough left on the risk budget to model in crypto. Not even close.
Electric vehicles, trend or fad?
Oh, that's trend.
And artificial intelligence, trend or fad?
I think that's also trend. I really do.
Well, Joe, this is great. What's the best way for people to learn more about you and Taiko?
Yeah, I guess jump out to our website by all means, taikoadvisor.com. You can look at partnerships that we work with independent RIAs around the country. Here in Chicago, our whole investment team stands at the ready for anybody who has some questions.
Fantastic. Thanks again. And thank you for tuning in to another episode of Trends with Benefits.